Financials, they're in focus today in our Fed-themed show. We got a double upgrade today for KeyCorp. Raised a buy from underperform at Bank of America. Degas, I come to you. You own the stock. And it tees us up for a conversation sort of big banks versus regional banks. And you have exposure to a bunch of regional banks. Huntington Bank shares, People's United, Citizens Financial, along with KeyCorp. Your thoughts?
So we like the regional banks for several reasons. Let's just talk about KeyCorp. What they've been able to do through their acquisition strategy is to grow their loan and deposits. That's exceptionally well. Also, it has a 3.4 dividend yield. A lot of those banks you just mentioned have really strong dividend yield. We hold that in our dividend strategy. And so these regional banks are the place to be because we feel they're more nimble than the larger banks. So we really like regional banks here.
So, Weiss, I'm not sure how we're supposed to think about this. Conventional wisdom says the prospect of higher interest rates is good for banks, right? Because of net interest margin and all that. And that's how we, generally speaking, speak about the bank stocks. Higher rates are going to be good for stocks. Lower rates, not good for bank stocks. But then Joe raised a good point yesterday about all this concern about an inverted yield curve, and that would be bad for the banks. So how are viewers supposed to think about this sector today?
Well, you sort of have to take a view on rates and the economy, because if the economy continues to slow down, you could see the inverted yield curve be a factor there. And while an inverted yield curve doesn't always presage a recession, it does the majority of the time. But here's what I'd say. Rates are going up. If there is an inverted yield curve, it won't be for long. I personally don't see that happening. We've had a couple of scares, but there's enough spread between it, and that's where the banks make their money. They make it on the spread and the yield curve. So I continue to be long the banks. I'm long BofA, I'm long Goldman, and I'm long the XLF. So I'm staying there. This volatility, we've seen it all along, but if you've stayed in position, and this will be a rate tightening cycle, make no mistake about it, and the Fed will continue to tighten, and the economy will be fine once we get through this latest variant.
I mean,
so I'm in. That's how you think about it.
Brian Moynihan yesterday with Wilf seemed pretty positive. Of course, they say that he gets paid to worry about everything, and he's worried about everything that you could possibly bring up. But he painted a pretty good picture.
Well, look, the banks are in great shape. They continue to innovate in their products. If digital currency is going to be there, they will have their own. Well, not so much their own, but they will be in the mix of it. So I just don't see much impacting what are relatively few global banks left in the world. And I personally think that banking M&A work is going to continue, and that's driving a lot of fees. SPACs may lessen, that may hit fees, but overall, you continue to have vibrant bond and equity markets, and if volatility picks up, you'll get even more trading revenue. So look, so as I said, I'm there. I think the fundamentals are excellent, particularly on BofA and Goldman.
Jenny, you come at this sector from a bit of a different place. You own American Express, New York Community Bank Corp, Navient, Umpqua Holdings, Unum Group, and Western Union. Can you tell us about a couple of those, why you choose not to own the big money center banks?
So by and large, the reason we don't own the big money center ones right now is just because of the dividend yield hurdle. We have in our growth portfolio, that's where the American Express is. All of the rest are in the dividend portfolio, and the objective of that is to have a 5% or better yield. So it's actually, I'm coming at almost the same exact place that both Degas and Steve are coming from. So it's, you know me, I don't like to be in agreement with everybody, and I'm completely in agreement with both of them on their theses. I think when I'm thinking about this sector overall this year, how in the beginning of last year I thought energy would be an easy space to make money, and I've been trying to think about what's good coming up. I think banks could be I think financials could be a very easy place to make money in the coming year. You look at their valuations, and they're just straight up cheap, right? They're across the board cheap. And to all Steve's points, right, they've got the wind at their backs in terms of interest rates, in terms of their consolidation, in terms of the maybe trading and volatility, whatever happens, they have lots of different diversified areas. I'd love to be in Goldman and Morgan Stanley, but they just don't meet my discipline hurdles for what I need. So we're not there, but it's not because they're not terrific companies.
I don't know. I mean, do they have the wind at their backs because of interest rates, as you just said? Really? I mean, I'm looking at 10-year. I looked down right when you said that. I looked at our screen, right-hand corner. I was like, okay, where's the 10-year right now? And I saw 144. And even with the Fed doing...
Okay, but here's the point.
Yeah?
It's not going... Okay, and this is me going out on a limb, and that's okay. I don't think interest rates are going down. I don't know if we go to 160, 170, 2% on the 10-year, but it's unlikely that we go back to 125 or 115. Unlikely. So I just think statistically, rates are most likely to head up. And I think the biggest thing for me is that valuation. They are so cheap. This is a sector that's been so neglected. And when we were talking before about flight to safety, you know what? If people want to purge all of the high octane, long duration growth tech, maybe they're a little bored with moving into Microsoft and Apple and Google and Amazon over and over every time. Maybe they actually start to diversify where that money moves to. And the banking sector, the financial sector, is pretty compelling. That might be a pretty nice place to hide out for the next couple of years.
Wrap it up, Joe. Last comment to you, Joe T.
The secular view that I maintain for financials is a very bullish one. We carry a significant overweight for Joe T. However, money center banks, the only name that I own is Bank of America. And it's not even because the yield curve might invert. It's just because the yield curve is flattening significantly. That's a challenging environment. I've owned Goldman Sachs. I've owned Morgan Stanley. I'm doing that exactly for the reason Stephen cited, the trading revenue. Going beyond there, Berkshire Hathaway, Interactive Brokers, which I own personally, and S&P Global gives you exposure to financials, doing it through the capital markets. I think that's the right way right now.
I mean, you missed a monster move in a lot of this sector, Joe. I mean, I look at the year-to-date gains for only owning one bank stock. There are some really big winners here.
Yeah, but Goldman Sachs and Morgan Stanley have both treated me incredibly well. I've maintained that position for the better part of the last 16 months.